Robschild, no investment advice. Welcome to the show where we view financial markets using technicals, macro, Ben Graham's investment philosophy, and crystal ball gazing. Today is Thursday, October 10th, 2024. Today's episode, we start by bringing up initial jobless claims. Initial jobless claims surge into limbo. Initial jobless claims comes out on a weekly basis. You can find a chart of the initial claims on the Fred website. Oftentimes I don't even mention this metric because a lot of the time it's not doing anything all super interesting. But today we had a pretty big surge. If you see this blue line, it's sort of hard to see because the line gets cut off on the website here. But this is a large move to the upside. Now, if we just take a look at this thing as a chart like any other chart, the points I want to make are that we have this recent low from October of 2022, and when we drag it to the next low point in January 2024, you can see that we've been having a higher low, and that's bullish for this chart. Initial claims basically going up. From the end of 2022 to the middle of 2023, we were obviously going up here. This is going up, and it was hard to say if this was going to be the beginning of the recession, but it wasn't. It went back down. More recently, we've been in a very obvious little pattern here. These two parallel trend lines, it's just been trending up, trending up, trending up. And over the last month, it's interesting, it really cracked below this previous trend, suggesting that, hey, maybe we're headed again back down, right? But instead, for off of today's report, we surged all the way back up to the top of this little channel here. So we'll clean the chart up a little bit, and we're going to take a look at one other trend here. We have a higher low and a high right there, right? We have a higher low, higher high, higher low, higher high, higher low, higher high, higher low, and then a lower low, and then a higher high. This is why I'm calling this initial jobless claims bringing us into limbo. It had been looking like we were breaking down in initial jobless claims, and now more than anything, if you average them all together, we're going like straight flat. So now we need to see, okay, is this going to be ticking back up, or are we indeed headed back lower? If I had to guess, with my crystal ball and all, I would think that it would be going higher. Consider that the Fed is still restrictive here. Consider all of these very bearish daily reminders. If you want to see me read through and explain them all, watch Monday's show. I do it every Monday. Next on the agenda, CPI came out hot today. Taking a look from a snapshot from Market Watch, we have, of course, the initial jobless claims. This column is the last reading of this, the expected and the actual. Consumer price index rose more than expected. We expected 0.1, it was 0.2. Core CPI, we expected 0.2, it was 0.3. Year over year, expected 2.3, actual 2.4. Core CPI year over year, we expected 3.2, it was 3.3. So hot all across the board. So while the CPI is saying everything's so hot, 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 and initial jobless claims is surging to the upside saying, nope, we're headed, winter is coming, kind of a thing. Well, what does the Fed funds think about that? From investing.com, not a whole lot. Previous day probability of no cut in November yesterday was 22%, dropping to 17.5%. So the Fed funds is saying that there's actually a greater chance of there being one cut in November now, obviously off of the jobs data, and taking, the CPI report with a larger grain of salt. Last item on the agenda, tomorrow, Friday, we have PPI coming out. So we get to see what's going on with inflation from a producer's standpoint instead of the consumer. The consumer standpoint today, producer tomorrow. Also, JP Morgan earnings coming out tomorrow with Jamie Dimon. And we get to see how the banks see everything and feel about everything. And that could really be important. They released their earnings, I believe it's 8:30. I read the report that said before the market opens. I think that's usually 8:30, but so before 9:30. Also, with the daily reminders, I have no updates here. Crystal ball reading remains that we have a bear market coming soon. I'm gonna change it a little bit. I'm gonna say very soon off of this initial jobless claims report surging up higher. The other part of this is that the Fed won't cut fast enough to save the economy. I think we're headed into a pretty deep recession or possibly depression. Moving on to the charts, the S&P 500 still looks bullish. We have an inside day after a solid green candle. That's bullish. Again, I think stocks are very, very expensive right now, and I don't think it's a good time to be buying them. But the chart says that it may continue higher. For the past 2 days, the VIX is showing divergence from the excitement of the stock market. We're still solidly above 20. This says there's plenty of fear here priced in. And this market is telling us pretty explicitly that there's a top either like now or coming really soon. We are still solidly in an uptrend in the VIX. I have loads of puts on HYG because credit spreads are crazily tight, and if all rates go up, then this drops anyway. I bring up the chart today because after this large red candle, we've been consolidating. This suggests that the breakout will be larger than it would have been if we were just continuing downward. So I do expect this to break, and I expect it to break down. I brought up on yesterday's show the 30-year Treasury yield, how we had just gotten exactly to a very major trend line that I had drawn going back many years, showing a longer-term head and shoulders top. I did not expect this to break. We cut through it like butter. If we get a closing candle above the wick of today's candle, then this is looking bullish for yields and bearish for things like TLT, long duration treasury bonds. With about 50% of my portfolio in long duration treasuries, I don't expect it to go up and up and up forever. I expect it to go down and to reach new lows, but we'll see what happens. Bitcoin breaking the psychological 60,000 level and breaking previous lows of this recent dip. This is starting to look bearish. It has become a decent leading indicator for more risky assets, including stocks in general. It has been operating as sort of a leading indicator, suggesting that maybe stocks are going to be following Bitcoin. Bitcoin, it looks, just looking at the chart, it looks like it's going down to me. Interestingly, oil going sideways here. Again, this has a lot to do with what's going on in the Middle East. I think that this whole run was just that. If we scroll out a little bit, you can see we were going down and down and down in oil until we had some more major escalations going on over there. And so I would expect the downward price of oil to continue. Wood, one of the places that a lot of people I don't think look at very often. I love using this as a leading indicator. I mean, it represents how willing people are to be, building their own building houses. How much are home builders buying wood for new houses? This is a huge leading indicator for me, and it's actually been going down and down and down lately. So I'm just keeping my eye on it. Generally, looking across a lot of charts, it seems like the S&P 500 is the only one that's still excited about going higher here. Everything else is yelling pretty loudly that the opposite, Last chart I want to bring up today is K-Web. After having this monstrous 40% rally, we had a break. This looks to me like it might be a bottom here. This is consolidating. I expect this to go higher. As bearish as I am on the S&P 500, when I keep saying, stocks are going to go down, there are things out there that are undervalued. This is one of them. I think that this fund in particular, K-Web, is severely undervalued until around the $45 to $50 range. That would be, in my book, still highly discounted, but not so severely discounted. And so that's why I can have that sort of dichotomist view, I guess I can call it, of those markets. But anyway, that's all from me and my crystal ball. Hope you enjoyed. Thank you for watching, and see you next time. Rob's Child.